Everybody, I'm David Bayes, your host here at Cavalier Associates, and joining me today is Paul Sargent with Principal Financial. Paul, thank you for joining me.
David, always great to be with you.
Excellent. Well, we're going to be jumping into the big, beautiful bill legislation and really what that means for business owners. So, without further introduction, let's jump right into it. Paul, from a cash flow and tax strategy standpoint, let's start with bonus depreciation in Section 179. It's been expanded. How are you seeing small businesses reinvest that freed up cash flow?
Well, David, that's a great question. I think starting off, let's think about who this really impacts the most. So, with this expanded 179 deduction, it's really going to impact those businesses predominantly that hold significant real assets on the balance sheet. So, think about your construction companies, your manufacturing organizations that have a lot of equipment, a lot of vehicles, things of that nature. So, what this additional amount of depreciation allows for these businesses to do is increase cash flow by claiming those larger upfront depreciations where they couldn't necessarily do that in the prior years. So what the one big beautiful bill basically did was allow for them to accelerate future depreciation into a more condensed time frame, allowing for more cash flow to be freed up in their businesses today. What we're seeing from a lot of these businesses now is looking for creative ways to reposition those dollars, whether it's investing in new assets. And where we see a huge opportunity is these businesses oftentimes are looking for ways to incentivize key employees in their organizations. We've now freed up capital that allows for them to reposition some assets to help maybe accomplish some of those other financial planning goals that many advisors that you work with are talking to those business owners about day in and day out.
I appreciate you planting that seed there because we are going to jump into the demographic part of this phone call and a lot of the research that Principal's done. I know that even AT&T, they fast forwarded their fiber optic program by a whole year as soon as this legislation passed. So even in the R&D world of things, you're seeing a lot of push in that direction. But let's talk about kind of the individual, right? The advisor, the attorney, kind of what most small business owners would be taking in a deduction, which is UBI. How should advisors be coaching their clients now that that 20% deduction is permanent and the phase-in thresholds have been expanded?
Yeah, so as we look at the pass-through tax entities, which make up the overwhelming majority of businesses, and then thinking about those who are in that service-related field, you mentioned the attorneys, the CPAs. Think about engineering firms, architecture firms. Again, similar to what we're seeing inside the Section 79, it allows for those businesses of those pass-through tax entities to take advantage of, again, further deductions of that additional source of additional cash flow in the business. And a lot of them are looking at it, whether it's reinvesting in their practices, they're hiring new employees, they're paying down debt. And again, we keep going back to maybe how these owners also look at maybe taking advantage of lower effective tax rates today into some tax advantage vehicles, inside of non-qualified planning for themselves. One of the key things around the one big beautiful bill is at the end of 2025, there was that sunset provision that was addressed, and that didn't just talk about the estate plan tax, but it also talked about the individual tax rates as well, which is going to impact all of these pass-through tax entities. Now that we have some certainty, those extensions were granted and made permanent, we're seeing more and more of these pass-through tax entities leverage these new deductions and also utilize those dollars again, repositioning to various forms of financial planning business.
And look, there's a lot to unpack in the big, beautiful bill, and even CPAs kind of struggle to dot every single I and make sure they hit every single check mark. But you talk to a lot of business owners day in and day out. You're engaging with them across the country. What would you say is maybe the single most overlooked provision in the big, beautiful bill? And how should small business owners be leveraging that?
Yeah, so I think it's the one big beautiful bill did a lot of things as far as creating ways to generate new cash flow in businesses. But what the one big beautiful bill didn't do is it didn't fix a lot of things as well. We now have a much larger estate tax exemption. So we're looking at obviously it's a smaller pool of individuals who have that true estate tax liability issue, at least as of today. But it still doesn't get away from the fact that estate planning is well beyond just tax planning for a lot of individuals. So it didn't address, how we are dealing with, potential transfers of business assets. It's not dealing with, 401k plans that are still limited for highly compensated executives. It doesn't always address on how businesses transition their business from one generation to the next. So there's a lot of things that weren't addressed in the one big beautiful bill that are still creating planning opportunities for financial advisors. One of the key areas I would say, to really hone in on for a lot of these business owners is the extension of those individual rates in the one big beautiful bill. If we look at where tax rates are today, it is still very advantageous for S Corp owners to look at non-qualified planning on themselves and doing so in tax advantage vehicles such as life insurance. We anticipate at some point in time, maybe tax rates go up, but we're in a time frame right now where tax rates are relatively low, and the one big beautiful bill extended that duration of how long those tax rates will stay low. So a lot of great planning opportunities as a result of the bill.
Look, it definitely cemented in, the legislation and a lot of the unknowns that were existing out through there. I know I was all over the place talking about them through 24, trying to figure out, how do we plan for the unknown? Now we have the known quantity, right? And with that said, a lot of those business owners that advisors were engaging with previously, they were a little uneasy or a little unsure because of that unknown legislation. And they were kind of saying, like, I can't afford to do that right now. I don't know that I want to do that right now. How do you reframe that conversation post Big Beautiful Bill?
Yeah, so I think it's a lot about we now have some certainty. To your point, earlier this year there was the question around will the Tax Cuts and Jobs Act provisions get extended? We now have certainty. We know that they are. Some of which are permanent, which of course we all know means permanent until the next, the next Congress comes in and changes it, but at least gives some certainty. The other thing I think we're seeing around, outside economic influences like interest rates, like tariffs, I think we're seeing some level of stability, at least kind of seeing where that progression is taking us. And the combination of those two things, certainty around the legislation and maybe some easing of tensions around tariffs and interest rates, I think have opened the doors now to business owners are willing to engage in these conversations because they're not terrified every single night of what's going to happen tomorrow. Obviously, this is a recording. We're in the middle of a government shutdown, so who knows what that's going to mean long term for business owners, depending on how long the government shutdown lasts. But as far as the one big beautiful bill does, it does create a window of planning. As we look at these provisions that are built in, as I mentioned, a lot of them are permanent, but again, permanent until somebody else comes in and changes it. So the successful advisors that we're working with, and a lot of times working with successful CPA relationships, is talking about taking advantage of the now. Because even though these provisions are permanent, they likely will change at some point in time in the road. So let's take advantage of the opportunity to do some planning, utilize the current cash flow that exists today, and basically just take advantage of the opportunity that's given to us in this short time.
I think the number of pages on the map has expanded enough to kind of we can see where we at least need to go and how to get there. So
Yeah.
it's a really great time to re-enter those conversations. And look, you planted the seed early on with regards to demographics and employee retainment, a lot of the things that the Big Beautiful Bill doesn't do. So let's let that tree break ground here and sprout. Principal does a phenomenal job in market research. You engage more business owners than I think any other firm or company in the country does. You do a lot of planning on businesses from, 5 employees to 500 employees. And with that said, when you look at that research, what are the top 2 or 3 pain points that business owners have around hiring and retention right now?
Yeah, so to your point, we interview hundreds of business owners every single year. And for the past 15 years, the number one concern that we have heard from business owners has been around how do I keep my best employees, my employees? So key employee retention is by far and away the biggest concern and has consistently been that way, post Great Recession. So we've taken a lot of real focus on how do we educate business owners on tools, programs, concepts that allow them to address that issue, and simultaneously being able to effectively create the financial instruments to fund these liabilities, which we'll talk about here in a little bit as well. The second thing is really around succession planning. We have an aging business owner population, the silver tsunami of boomers transitioning businesses from generation one down to generation two and so on. there's a significant need to do buy sell planning. And a lot of business owners were really, coming through COVID and into the world we are today around how do I want to transition my business. So the feedback we get in these surveys is really around how do I protect from losing my best people, my key employees, and then what's the appropriate time and process to transition my business on my terms. And so having advisors go out and talk about those two core concepts to business owners are where we're finding the most opportunities to talk about doing insurance planning and overall financial.
And when you're thinking about planning for your employees and employee retainment, I mean, you have employees across various generations now: Gen X, Millennials, Z, Alpha, Beta, Vons, Kroger. Like, I don't know what's going to come next, but how do those generational differences impact benefit planning and retention strategies? What's important to those?
Yeah, this will come as a surprise to nobody that different generations value different things. So as we look at that breakdown of the boomers, the Gen Xers, the millennials, there are obviously different priorities. They're all in different stages of their lives. When we look at a lot of the baby boomer generation, a couple of the biggest concerns that they have and things they want as far as creating benefits are around retirement planning. And of course, number one is healthcare. Looking at transitioning healthcare into retirement in their later years when that becomes more of a prevalent issue. Long-term care planning certainly are things that resonate with that boomer generation. You pivot that down more to the millennial generation, which I can hand up. I'm an elder millennial, a geriatric millennial here. The thing that is really focused in on that millennial generation from a benefits perspective, it's still retirement planning, but there's also a lot of things around work-life balance. There's a lot of things around technology as a part of the platform. And then if you go into now where we have the Gen Zers who are making up a significant amount of the workforce as well and continue to grow, that hybrid work environment, that ability to have vacation time, and not just saying that because they want that work-life balance, but it's about kind of meeting them where they are, finding their skill sets, meeting those employees where they are, providing their benefits packages. I know David, you and I have talked to a lot of advisors, but there are certain things like having pet insurance as a option on your, cafeteria plan in your organization. We met with an advisor who had, a car washing detail come to their office every week. Those are things that resonate with certain demographics that might not be as important for others. What we are finding, though, across all generations is that customization of benefits is really, really important to almost every demographic. They all want to prioritize different things. So the best business owners that are tackling this are going in with an open mind and trying to create specific benefits for specific subsets of their employees. And a lot of that can be done in the form of client retention and employee retention, which we'll talk about in more detail here in a moment.
It was fun running around with you over the course of 3 days and hearing some of the benefits or bonuses or kind of extracurriculars that business owners do for their employees. And I think it was great. The one was a car wash every other week. And I know in Iowa that probably doesn't work out too well. Southern California, you could probably get away with that. So I would tell advisors, ask your clients, hey, what are you doing? And if they're not doing anything or they're looking for ideas, I mean, you can go and talk to your other business owner clients and see what they're doing and kind of share that information. Or, it's amazing how much the taco bar, the pizza party, or the car wash will actually mean to your employees. It was kind of wild how important that was to them.
Yeah, and I think, David, in addition to that, I think where we're separating things out now is what matters to all employees, and then again, I think where we're going here is what matters to a select few of employees who are your best employees. If I'm an advisor having this discussion with a business owner, it's really about identifying who are those key value added employees in your business to maybe create some additional layers of benefits that not everybody gets. Best phrases I've ever heard or best questions I've ever heard an advisor ask was ask your business owners who is the last person that you want to have walk into your office and hand you a resignation letter. If they have a couple of employees or one employee who their number one salesperson, their number one account manager, their top engineer, their highest, billable attorney, what are they doing to create benefits that are tied specifically to that individual? Most business owners do not know that they can create exclusive benefits that are compensation tied benefits for those key employees and not just giving them cash. We do a significant amount of non-qualified planning, which we'll dig into in a few examples here momentarily. But educate your business owners, ask them the right questions about how do you maybe create some asymmetrical benefits for your asymmetrical contributors in your organization.
Well, and look, that bleeds right into the next section, right? Which is not all employees are created equal. And walk us through how a business might use life insurance to create a selected benefit plan for key employees.
Yeah, so when we talk about the world of non-qualified planning, it's very common. I get a call from advisors say, "Hey, my business owner read an article. They want to put a non-qualified plan in place." Well, a non-qualified plan can mean a lot of different things, but ultimately, what business owners are looking to do is how do they create that specific plan for a key individual or a handful of key individuals. And oftentimes we always start with the concept. We're typically looking at, how do we create a plan for that key individual? And then the underlying piece will be how do we finance that, where life insurance typically comes into play. So a couple of quick examples. So if I use David as my key employee, I could give David cash bonuses at the end of every year and reward him that way. Does that really build loyalty? Maybe. Does it retain him? Probably not. If he gets a phone call from a competitor down the street, he's likely going to wait till January 1st when that bonus check clears and then take the opportunity. So what I can do is I can create, many of you have heard golden handcuff plans for these key employees. A very common plan design is what's called an executive bonus arrangement. I simply bonus David dollars, but rather than put it in his checking account, I put it in a cash value life insurance policy that he owns. He gets to name his own beneficiary. I get a current deduction because it's treated as compensation to David. But ultimately, I'm creating a benefit solely for him that I don't have to do for any other employee. Now, the downside is David owns it. If he leaves, he's going to typically take it with him. Now, I can have restrictive agreements, investing, but ultimately, I'm giving up control as the owner in order to get that current tax deduction. What we're seeing more and more of now is an alternative where I'm really concerned that David is a hot commodity. I want to put a retention plan in place, but ultimately, I don't want to give up control because if he leaves, I don't want to have given him all this money to then walk away. So instead, we see a lot of split dollar arrangements. We at Principal, we refer to it as a select reward plan. And it's a very simple plan where what I do is I create an agreement where I say, David, for the next 7, 10 years, however many we decide on, every year I'm going to put dollars in an account on your behalf that is corporate owned. If you stay and fulfill your obligation at the end of that time frame, I'm simply going to give you that account. What I'm doing behind the scenes is I'm buying a corporate owned cash value life insurance policy on David at what I can only assume is super preferred non-tobacco rates, right? Fair enough. When he fulfills that obligation, I can either use company cash flow to pay him an equivalent of what that policy has grown to, or I can simply give him the life insurance contract. At that point in time, he recognizes it as income. I take a nice big tax deduction. He's stayed with me for that entire time frame. Conversely, if David leaves 5 years into this 10-year window, he walks away with absolutely nothing. I've now accumulated this policy where I can use those dollars to find his replacement or simply just keep it as an asset on the company balance sheet. Either way, I have control of that asset. So it gives the owner more flexibility and control of knowing that retention is the priority, not necessarily giving him that current reward today. So either way, we've got options that are available, and there's several other plan designs that range from more complex to even simpler beyond the select reward plan that can help customize these benefits. And again, we typically will fund these with life insurance because one, there's a tax advantage to the buildup. Second, there's typically a need for the actual death benefit, whether key person or the bonus plan scenario, protection for David and his young family. There's benefits to using the insurance in all of these different types of arrangements.
And it's one thing to use these plans in order to retain key employees, right, or to attract new employees as well. But these policies don't just stop from an income standpoint, right? Whether it's income deferral or kind of some type of golden handcuffs plan. How can these select benefit strategies actually serve as a succession or exit planning tool?
Yeah, great. I mean, great question. I think as we kind of marry those two things together around key employee retention and business transition planning, It's oftentimes where maybe that owner doesn't have a specific transition plan already laid out. Maybe they have a key employee or two that they think are the successors. The biggest challenge is, how do they actually get the key employees to buy the business? Very commonly, if David and I'm the owner, he's the key employee, and he's much younger than me. If he's going to buy me out and I have a $10 million business, he likely just doesn't have 10 million in cash laying around to write me a check. So what's commonly done is we'll go into a buy-sell agreement, and there's going to be some sort of installment sale over 5 or 10 years, which is fairly common. Now, the challenge with that is what happens if there's outside influences, the economic environment and interest rates, whatever it is, and it hurts David's ability to turn a profit? What happens if he gets sick or hurt and can't run the business and can't turn a profit? What happens if he's a great employee but terrible at running the business? Me as the departing owner, my retirement, my value coming from that business is all predicated on David being there to run the business, turn a profit, and pay me out. So in reality, we would like to shift that risk, get a third party involved like a bank. Well, if I have a $10 million business, most banks are certainly going to want to have some level of collateral or down payment to have that kind of note to the business owner or to the key employee buying from that business owner. So what we oftentimes will see is that same select reward plan design where the company's funding this deferred compensation benefit, where if David sticks around and helps me grow this business for the next 5, 7, 10 years, I can then bonus him those dollars. He then turns around and is required to go to the bank, use it as down payment collateral to secure a loan, and then buy me out of the business. So we're creating an inside transition plan. And if David dies, hey, I've got key person life insurance. But if he lives, I've created a known buyer at a known time at an established price with funding already in place. So we're helping that owner create their transition plan while also solving a key employee retention issue simultaneously.
It's an excellent kind of dual-edged sword, right? So really able to cut both ways on that, and it's a great tool for that. I mean, that is always one of the biggest issues I run into with business owners. Is it's just the first question is, as you said, who's the most important person in here in your organization, and then the second one is what's your plan when you leave. And those are typically that second one almost nobody ever has an answer to. They just hope their kids grow up and want to do what they did, which I think is sometimes a Hail Mary approach, and not everybody's Doug Flutie. So, look, our goal is to always position or to educate advisors in order to be real coaches to their clients and to really sit on the same side of the table and be a part of that overall planning team, not just the money manager, but like the accountant, like the attorney, and really help coach them through today, tomorrow, and eventually the legacy part of it. So when we think about real world applications, what's one real world client example where the advisor helped a business owner unlock hidden value, whether through benefits or tax planning?
Yes, I've got countless, different business owners that we work with, but there's a lot of it where I'll give you an example of a construction company we worked with. So large multi-generational family construction company where you had G1 who was transitioning out of the business, G2 who was in his fees, and then G3 late 20s, early 30s kind of coming into the fold of equity ownership. The valuation of the company was about $100 million, and they really had done no planning. So the question was more about how do we create a strategy to cover the transition of G1 shares down to the next generations? How do we take care of maybe a couple of key employees? And then how do we, create that continuation plan for the next two generations so that we continue that familial type of business going forward? In that circumstance, we're utilizing tools like Principal's informal business valuation, our complementary buy-sell agreement, and we're looking at what the planning has already, what planning has already been done, and then matching that to the goals and objectives that we see today with that business owner. As it turns out, they hadn't updated a few things, there was some lacking of funding, and what we ended up having through multiple discussions with our attorneys and CPAs and our advanced solutions team, as well as my team, the client CPA and attorney, along with the financial advisor, is that here's how we're going to stair step insurance on G1. We're going to do some estate planning on G2. And then we're creating a large amount of insurance that is corporate owned through kind of a retention plan for this G3 who's got a small amount of shares, but eventually going to be buying more into the business as time goes on. So we take a very hands-on approach. We've got different tools and resources that we can utilize, but it is a team effort. We work very closely with the advisor. We work very closely with CPAs and attorneys, as well as our CPAs and attorneys. And we want to make sure that we're putting the plan in place and ultimately creating the insurance sale, that we've done all the work ahead of time. So we've got the concept already built and the insurance slides right in. And obviously, we're a big part of these discussions as well, going back to the one big beautiful bill. As all the advisors listening to this have ever figured out, it's the hardest part of working with business owners is, hey, we've got to have you write the check. Where is the money going to come from to actually purchase the insurance, to implement these plans? The one big beautiful bill has done us a lot in the world of, we now have a way to show them that, hey, talk to your CPA. Here's the different things that this piece of legislation did. This should free up X amount of capital. We can now reposition those dollars to fund these new obligations through these new plans that we're making these recommendations based on.
And look, your business valuation tool is really, really well detailed, very well put together. I mean, I've been using it for over a decade now, and it's really helped advisors that I work with take clients from the corporate planning all the way through the personal planning and beyond that into legacy planning and multi-generational planning. So it's a really, really great tool. And the advisor doesn't have to be an expert in business planning, corporate planning, tax strategies, this, that, or the other thing. I've seen them, they rely on you, your team, to engage with the client, the COO, the CFO, the CEO, the CPA, and any other C's that you want to throw out there. But you'll engage with them. You'll handle the life insurance, the disability, the business overhead. Like, the list is pretty long, and you don't have to implement all of them, but it's good for the business owner to understand. And one of the ways that I always convey that is, a lot of business owners just don't have a roadmap. And that valuation gives them a roadmap of things to follow to get to where they want to be, or they're kind of able to choose which ones they want. And then here's how you get there. So you don't have to be an expert in order to have these conversations. And that probably leans into the next part is, what's the lowest hanging fruit advisors can act on today with their small business clients to open up these conversations?
Yeah, so timing wise, as we are now, less than 60 days away from 2026, business owners right now are sitting down and looking at year-end planning and starting planning for their next, calendar year of 2026. The two things that really stand out to me, number one, right now is the time to be engaging in these executive benefit discussions. Business owners are looking at, what am I establishing for year-end bonuses? How am I going to look at compensation increases for 2026? Who's getting a raise? Who do I want to treat? How do we figure all these different things out? They're meeting with their benefits teams, or meeting with their property and casualty agents around doing renewals on those different lines of business. So their year-end planning is in full swing. The executive benefit discussion folds right in because, again, most business owners are looking at, how do I give cash bonuses or a salary increase to retain my best people? We can now, as advisors, take that as an opportunity to educate them on these non-qualified solutions, these specific plans for their best employees, to maybe not just give them the cash bonus, but to create a plan that incentivizes that key employee, that retains that key employee. So those discussions are happening. As an advisor, that to me is the number one priority. The second thing would be going back to that business continuation, business succession discussion, wrapping up their fiscal 2025, they're doing their year-end planning. It's a good opportunity while they're reviewing all their benefits, all their compensation, all the things business planning wise, to look at their buy-sell agreement. As I kind of briefly mentioned earlier, a part of that valuation process, our attorneys also do a complimentary review of a client's buy-sell agreement. And the idea behind the review is, not to say like, hey, your attorney is not very good for having drafted it this way. It's more about, here's the best practices that we've seen based on the 400 reviews we do every single year. Where does your agreement check out? Do you have all the right triggers around death, disability, divorce, retirement? Is the valuation methodology current? Is it concise? Are all the parties listed? Is the dang thing signed? We probably review a buy-sell agreement every 2 weeks where the agreement is not executed. It's simple things like that that we all kind of joke about, but are really important and impactful, that can make the difference of if a business survives the death or disability of one of their owners. And a big part of that, obviously, is, what does the underlying insurance look like? Is it funded with life insurance? Is it the right amount, the right type? Is it funded with disability buyout insurance? Most buy sell agreements have provisions around disability. Very few, if hardly any, actually have disability buyout coverage funding that obligation. Those are all things that we look at as a part of that review. Timing wise, again, the fourth quarter, business owners are open to these kind of reviews. And as David, you mentioned, you do not need to be an expert as an advisor. Our CPAs and attorneys are client facing. They will join myself, you, the advisor, and your client to highlight these things and provide, guidance on what should be the next steps. They don't charge fees for that service. When we help do the point of sale work, presenting these ideas and topics in the insurance, we're not taking revenue share. We're simply here as an additional resource as a part of the Cavalier team to help educate, your business owner clients on really where the opportunities exist to improve their overall plans.
I think that's really, really important to take advantage of the services that you and your team there at Principal actually provide. I know just this morning you had a call with an advisor that I work with and a technology firm. And I know that's, I want to say that's the third call you've had with them, but you've done evaluation with them. You've reassessed their growth, reanalyzed their growth and kind of what they expect, what the numbers represent, and kind of pulling that all together. And the other part to it is really that buy-sell review. I know we talked about a number of issues. We're not going to get into each case example now, but either ones where the buy-sell wasn't properly signed, wasn't properly adjudicated, and families are ripped apart, or the other part where they did a buy-sell 25 years ago and the business is 35x what it was. That's obviously going to be a big problem. And in that specific example, thank God nobody died. So there are some really interesting pieces like that. So let's leave it here, Paul. If you're coaching a new advisor, wants to jump into the business marketplace, maybe they have their clients, they're managing them on the personal side. This is something I see a lot. What 3 questions would you have them ask every business owner they meet?
Yeah, so I would go back into starting with the business succession planning. Do you have a buy-sell agreement? And if so, when was the last time it was reviewed by an independent third party? So number one question around business continuation succession planning. Number two is going back to that key employee strategy around, really who is the last person in your organization you want to have walk in tomorrow and hand you a resignation letter. And then really the third thing is about, owner transition planning is how do you envision transitioning or slowly stepping away from the day-to-day of your business? I think a lot of us as, planners who work with business owners day in and day out, the idea of a business owner is going to basically just say, hey, Friday's my last day. I'm sold the business. I'm going to walk away and go play golf every single day. That realistically doesn't happen. Putting that business succession in context of being able to slowly step away on your terms is what will get that advisor in the door to talk about that business transition planning, the estate planning that goes along with that. So again, buy-sell planning, key executive benefit planning, and then really that exit planning, for that business owner are really the core things that advisors should be doing.
Well, Paul, I really, really appreciate that insight and appreciate your time. I value it highly. So thank you so much for joining us today. And I look forward to hosting you in January or February because people just love listening to you. So I think you're pretty popular out there. And you as the advisor, if you're listening to this, you're watching this, you want to engage with Paul, you want to learn more about this, just reach out to me. Reach out to us here at Cavalier Associates. We're going to plug you in with Paul. So Paul, again, thank you so much.
Thank you, David. Always appreciate the time.
Have a good one.